The pressure to raise interest rates is no longer a uniquely American story. For much of the past cycle, the Federal Reserve stood apart as the most aggressive rate setter among the world's major central banks. That is changing. Market expectations for rate increases are now building across several major economies, and the implications stretch well beyond any single country's borders. When a central bank raises its benchmark interest rate, the goal is straightforward: make borrowing more expensive, slow spending, and bring inflation down. It works, but it takes time, and it comes with real costs. Higher rates create headwinds for economic growth, push down asset prices, and raise the burden on governments carrying large debts. Now consider what happens when multiple major central banks move in the same direction at roughly the same time. That is called a synchronized tightening cycle. And it amplifies those pressures across the global economy simultaneously. The European Central Bank, the Bank of England, and the Bank of Japan have each been navigating their own distinct inflation dynamics. Local wage trends, energy costs, and currency movements have all played a role. But the underlying force, persistent inflation that has proven harder to shake than many expected, is shared. That common thread is what is now driving rate hike expectations beyond US borders. For bond markets, the mechanics are straightforward. When rate expectations rise, yields move higher, and when yields rise, the price of existing bonds falls. Investors holding long-term debt feel that pressure directly. For stock markets, it is slightly more indirect, but no less significant. Higher global rates raise what analysts call the discount rate, essentially the benchmark used to value future corporate earnings. When that rate goes up, the present value of those future earnings goes down. Growth-oriented companies, whose valuations depend heavily on earnings projected years into the future, tend to feel that pressure most acutely. There is also a currency dimension. Capital tends to flow toward economies offering higher yields. Countries that lag behind in the tightening cycle can see their currencies weaken. Emerging markets face a compounded problem. A stronger dollar and rising local borrowing costs can hit simultaneously, creating financial stress that spills into growth and debt dynamics. The Fed remains the central actor in this story, but its decisions now land in a more complicated global environment, one where other major institutions are increasingly moving in the same direction, amplifying rather than offsetting the effects of tighter policy. In the weeks ahead, watch central bank communications closely. Statements from the European Central Bank, the Bank of England, and the Bank of Japan will offer the clearest signals on whether this synchronized shift is just beginning or already nearing its peak. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.